So let's go ahead and get started. Markets are looking a little weaker than the past few weeks, so let's go ahead and get started. But before we do, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So as we normally do, we'll take a look at the equity indices where they currently sit. We've seen some movement here in terms of the overall indices, but the biggest movements are really coming from the fixed income markets, some commodities. And so we'll take a look at the sector rotation model. We see quite a few sectors that are continuing to strengthen, some of them that are continuing to weaken. We'll take a look at one subsector that's currently on the move, and then we'll look at some bullish and bearish opportunities here in the broader markets. So starting off the S&P 500, the weekly chart or the longer term chart still remains very much intact, but we're starting to test this 20 period moving average here to the downside. And if we look at the daily chart here, so far, we've broken the 20, we've broken the 50, and then we reclaimed the 50 over the past few trading sessions. But as of this morning, it looks like we're about to gap down below the 50 here again. And this puts the S&P back into much more of a neutral tone rather than a continuation higher. So if we see the break here this morning and it closes below that 50-day moving average today, my expectation is that we see more sideways action for the S&P or the major indices rather than a continuation higher. And as you can see, daily momentum has already turned negative. Longer term momentum still remains positive, but certainly weaker here at the moment. You see the similar price action here for the NASDAQ 100. We've broken below the 20 and the 50-day moving average, reclaimed the 50-day moving average, but was rejected at the 20-day moving average recently. So we're about to gap lower here again. So just like that, just like the S&P 500, my expectation for the NASDAQ 100 is at this point far more neutral. If we break below 360, that's when things could start to turn bearish here at the moment. We haven't done that yet, and it's still a bit away from testing that 360 level. And until it breaks that level, my expectation is more neutral for these types of markets. And what was constructive here is on the somewhat of a weaker day, we saw an extremely strong day here from the Russell 2000 small cap indices. So we're starting to see better participation from small caps and value stocks over the mega cap higher beta names. And that's largely overall constructive here for the broader markets. So especially if we start to see the S&P and the NASDAQ start bottoming and we see participation from small caps, that could be, the support that the broader market needs to continue moving higher. And then when you look at the RSP, the equal weight S&P 500 index, this is one where it continues to really fail to make new highs and is starting to see some continuation to the downside. So everything is still, we're not seeing a lot of participation from the S&P 500 names on the subsequent rally here. And this is really where this is evidence that the current market is not particularly strong. And then especially the Dow Jones Industrial Index failing to break out above its May 5th highs shows us that the Dow also remains fairly weak and far more in what I would consider more neutral territory than outright bearish too. Unless the Dow breaks below 335, 336 or so, which is the support level here to the downside, that's when things get bearish. But until that happens, I'm not outright bearish here on the broader markets. But the big news was TLT, the bonds. We got rejected here at that 151 resistance level. It traded all the way down to the bottom end of the range, and we actually broke below the bottom end of the range. So bonds selling off fairly heavily here over the past week or so as the combination of inflation expectation and the Fed policy has started to spook bond investors a little bit, sending yields higher here. As we can see, the 10-year yield has risen substantially out of the trading range that it's been in for quite some time, now up to the 150 basis point level here, and potentially starting to continue to march higher towards that 170, 160 level that we saw earlier this year. And that's going to provide some move for the U.S. dollar. We've seen the U.S. dollar struggle to break out from this $93 level here. This has been a major resistance level. We are starting to see potentially this breakout higher here. So this is one that we are watching to see if the dollar does break out, and that's going to have ramifications for assets like gold that are priced in dollar. We continue to see this, as you can see, gold continue to decline in pricing on the daily chart. It's been very choppy lately, but we're continuing to see some downside. My expectation is that we're likely going to retest 157 or so, 158. If we break below 158, that's really where I think we could start to see some further downside down into the well into the 140s and potentially even 130s here to the downside. So gold, bearish trend continues and is at risk, in my opinion, of falling back even further. But we have seen crude on the flip side move substantially higher. And this is more based on supply and demand. We're starting to see some increased demand for crude, especially as electricity needs across the world is starting to increase here. We've seen that supply constraint in supply constraint in both the UK and China. We've seen China roll back power in a lot of places right now because of electricity demand. And this has pushed natural gas, pushed oil prices higher here, and we don't have a ton of supply. So this is really what's causing oil to break out higher here. And this is really where we could see some substantial upside for oil. And this is going to provide some support for energy stocks. We're going to talk about that in a little bit. And then Bitcoin, something that a lot of investors still pay attention to right now, back at the $41,000 level. This is a major support and resistance level that's worth paying attention to. If we break below 40,000, this really puts 30,000 back into contention. So for those Bitcoin traders, this is one where you could potentially see some big moves here to the downside. So taking a look at sector rotation, we do see a fair amount of rotation here. We have 4 sectors in the improving and leading category, 7 in the lagging and weakening category. You have energy, the big move here on energy, on those oil prices that I was showing you. Consumer discretionary has been leading for quite some time, but it's starting to lose some momentum here. Financials, one of the big gainers here this week on the back of higher interest rates. All the banks have rallied. And also industrials. We've seen some rally here from industrials. So those are the 4 leading and improving categories here. And at the same time, we saw consumer staples lose ground. We saw healthcare lose ground. We saw technology lose ground, real estate, communications, utilities. I would say the biggest mover here has been communications and utilities. Utilities, a very interest rate sensitive sector, as well as real estate is an interest rate sensitive sector. That's why we've seen some moves here to the downside. We're starting to see materials creep up a little bit, but it's still firmly in the lagging category here. So quite a bit of movement here in the sectors. So this is the sectors watch list here in the options play platform. You can see it. What we see here is utilities is extremely weak with bearish trends. Materials is weak with bearish trends. And on the flip side, you have financials that is extremely strong with bullish trends. Energy that's extremely strong with bullish trends, as well as consumer discretionary. Those are the 3 strongest sectors. But as you can see, both real estate and technology, strong sectors, but as you can see, the 1-month trend starting to turn lower here. So this is the rotation that we see, and staples, healthcare, and communications, as you can see, trends have started to deteriorate here to the downside. So taking a look at some of the sectors that I think are worth paying attention to, energy, like I said, breaking out from its trading range. It's been in this range for quite some time. We finally broke out from the upside of that range. So this really puts energy in potential contention back towards 56 for XLE. We have financials that has broken out higher from its trading range, about to retest its all-time highs around 38 or so, 38, almost 39 or so. If we see a breakout here from XLF, that means we're likely going to see financials and banks continue to move higher here. Utilities, like I said, very interest rate sensitive sector. Broke below, what was a breakout level. So as you can see, this was the all-time high. We broke out from that level here earlier in the year. It really failed to gain any momentum on the breakout, and then started just a few days ago break below that breakout level of 68 or so. And since we've broken down, utilities has continued to tumble, and especially as yields continue to rise, this is really where I expect a little bit of choppiness probably, but likely continuing to the downside towards that $63 level here for utilities. And then technology, this is really the one that we want to pay attention to because this is the strongest move. This is where a lot of the outperformance from the broader markets have come from over the past year and a half or so, and we've finally started to see this start to move lower here. And XLK hasn't broken support yet, which comes in around 151 or so, but if we start to break below these levels, that's really where we start to see some significant downside. We're going to talk about some of the stocks that fit into this category or into this sector that we want to pay attention to here for today. And then the one subsector that I want to pay attention to here is biotech. Biotech, similar to the XLK, higher beta sector. So when you have higher yields, the higher beta sectors are the ones that are at risk of a major pullback. And what we've seen is IBB has been extremely strong. Biotech has been extremely strong since the beginning of the summer. And we've seen yesterday's price action, a break of that trend. So strong trend, but as you can see, the all-time highs were around 175 or so. We tried to break out once, it failed. We tried to break out twice, it failed again. And now what we've done is we've broken this overall trend line. And that is, in my opinion, a end to this trend that we've seen since May or so, and this signifies that we could see some further downside here for biotech. So biotech looking fairly weak here at the moment. So looking at some opportunities here in the broader markets, we really have to think about interest rates right now. The move in interest rates is going to it's going to provide different expectations here for different sectors. You have financials that are very interest rate sensitive that are going to benefit from a higher yielding environment. So when you look at major outperformance in this particular space, Morgan Stanley certainly stands out in terms of a top asset manager that will benefit from these higher yields. So if you look at Morgan Stanley, we have a triple top here around 105 or so. If we see a breakout here over the next day or two, that's really going to point to substantial further upside here for a name like Morgan Stanley. At the same time, you also have some smaller regional banks that are also going to outperform. TFC, some of you may know this as BB&T, and this is really a breakout here that we have seen recently that is likely going to target its all-time highs and very likely, in my opinion, break out above those all-time highs to new highs. So this is one that we've recently also seen quite a bit of volume on this move higher here. As you can see, above average volume, breakout here above the $59 level, that gap higher here. This is likely to continue up towards that 63 and potentially higher for some of the smaller regional banks. And then the energy players, ConocoPhillips, one of the largest energy producers. We've seen this big move higher here that breaks out above its recent highs. That was all on very high volume or above average volume. So this is one that we also expect to see some further upside. Now, the one thing I do want to point out here is we've had a pretty big move here over the past week or so. We could see a little bit of volatility. My expectation is that a pullback here is a better entry point for a continuation higher, but this very well just could continue moving higher without pulling back. And on the flip side, as interest rates continue to rise, that's going to put some pressure on the higher beta sectors, especially the higher beta sectors that have exposure to China. And Apple has a fairly sizable exposure to China. And as we see a slowdown happening in China in real time, this is really where Apple's price action mixed with the fundamentals right now looks somewhat poor. Apple tried to break out higher here above this 147 or so, the all-time highs. It tried to break out and actually had this acceleration here to the upside on some optimism, but that quickly faded, and we've seen this pullback, break below 145. It's now starting to test 142 or so, which was the, I would say, the base that it built to try to break out higher here. And now that we've gone all the way back to retest 142 once, maybe if we test it twice, this is what I'm looking for. If it breaks below 142, there could be some substantial downside here for Apple. And Apple trades at some fairly rich valuations here for a company of its size. And this is really where we could see some potential downside for Apple. So far, 142 is going to be more neutral because it hasn't broken 142 yet, but this is one that I'm watching for a potential break below those levels. And then we also have United Rentals. United Rentals, extremely strong industrial stock, as you can see, a clear outperformer of its sector. And recently, we've seen this continue to break out higher here. This is one that I'm watching because I do see a little bit of negative divergence as we made a higher high in price. We did not have a higher high in momentum, but this is one that continues to see a lot of strength here. This is one that could continue to move higher here, but I would watch to see if we have a breakdown and a pullback before looking for that long opportunity here for some of the industrial names that are starting to see quite a bit of strength. And then we see some of the other technology stocks, higher beta technology stocks like Cloudflare. This is one that I think is worth paying attention to because as of today's open, it's likely going to close open below the 50-day moving average. This is one that has seen an incredible amount of strength here, but momentum is continuing to slow down on this continuation higher here. And we've now seen the break of this primary trend. However you want to draw this trend line here, but we've seen a break yesterday. We've seen a continuation looking like what looks like a continuation lower below the 50-day moving average on the open here today. And these higher beta high growth tech stocks are the ones that are most at risk of a pullback as yields continue to rise. So we've seen the break below the 50-day moving average and we've seen the daily momentum turn negative. This is the potential first warning signal of what could be a further pullback here in some of these higher beta tech names. And then we also see some of the more staple type names like Hershey's, form this giant distribution top, if you will, started to break below some major support levels and came back to retest those levels as resistance, and as of yesterday were rejected from those levels. We've seen the 20-day moving average cross below the 50-day moving average, and this is really where we can expect to see some further downside from some of these names that have just seen a very strong move here to the upside, but are starting to lose momentum and starting to see some rejections at their support levels or broken below some support levels, and after a retest of those levels have been rejected. Another one that I think, not only have we seen a slowdown from, but also fundamentally speaking, U.S. Steel. Whenever we look at some of these steel-based companies or commodity-based companies, especially companies that are dealing in commodities that have a large amount of exposure to the China real estate market, that's really where we see some further risk, especially with the Evergrande debacle here right now and what could be a substantial slowdown here in terms of Chinese housing construction. Companies that are dealing in copper and steel, iron ore, these are the base materials that are required, that are needed to build. And if we see a substantial slowdown in Chinese building, these are the types of stocks that will suffer because the commodity prices that they are dependent on are going to see some downside. So when we look at U.S. Steel, very big breakout here from $11 all the way up to $31 here this year or over the past year or so. And we really have started to see this momentum slow down. And if you draw your lines this way, we recently had the breakdown. It's come back to retest this level as resistance. And this is one where I could see some further downside for U.S. Steel. So with that, that covers what I wanted to share with you here today. So just remember, markets are looking a little bit more neutral as of today's morning. We've seen a higher interest rate environment. That interest rate environment should shift your thinking in terms of what symbols and what sectors to pay attention to. Financials, seeing some support from these higher interest rates, and then the higher beta technology names, materials, industrials that have exposure to China, those are the ones that you're likely going to see some further downside. So with that, thank you so much. I hope you guys have a great trading day.